So 15-year versus 30-year mortgage, this is usually a no-brainer, and most folks are pulling 30 years obviously here too. So what are the advantages to a 15-year versus a 30-year when you guys go to buy your next home or refinance or whatever? Typically that 15-year mortgage is going to have a slightly lower interest rate. From what I see out there, it's less than a percent, sometimes half a percent, which may seem attractive to you. You're going to look at that whole loan and you're going to say, wow, I saved so much on interest over the lifespan of this loan. Why would I not do this? It's probably six figures of interest. And so it's a no-brainer to do a 15 versus a 30 year. But on the other side of that, I'd like to argue the interest that you are discussing here is tax deductible, usually front loaded as well. So while you're in your earning years, you might be itemizing on your taxes. It actually might help you to have more interest itemized over those, 10, 15, years essentially that you're working and earning still, right? So it is tax deductible interest here, which is the differentiator. And then, like I mentioned, it's probably under 1% from what I see out there is really the interest savings on the actual interest rate on that thing. I'm a big fan of flexibility. So when you pull a 15-year mortgage versus a 30, you have a much higher monthly payment. And I think most people out there already understand that, of course. But what you're doing with that is you are maybe pigeonholing yourself for the unknown. If you were to lose your job, lose employment, be unable to work less hours, become unemployed, whatever other liabilities kick up, you really put yourself at a significant risk here for foreclosure versus having a 30-year mortgage with a lower monthly payment. So that's my number one reason why I would pull a 30-year, not a 15 myself. And the second option is flexibility. If you are raising kids, or again, you have some unknowns potentially in the first 15 years or so, wonderful. Pay that monthly minimum on the 30-year mortgage. And then as you start to age and you start to get above that age 50 mark, 55, and you're getting closer to retirement, then what you can do is start applying extra towards that principal on your mortgage on the 30-year and still get it done early and save yourself, whatever the amount of interest is that you want to save yourself. Again, I'm an advocate of really not paying them off early unless maybe it's your primary home and maybe you are within that 5 to 10 year mark of a real, true, actual early retirement. Other than that, I would drag it out a bit too. Let it, you can invest it elsewhere essentially. Another good example is if your mortgage is at a 5 or 6% interest rate on a 30-year, you should pay the monthly minimum on it, invest the difference if you're good with money or you have someone pushing you to do that, like me instead. We're going to invest that difference and we'll probably, not guaranteed, but probably make a higher rate of return in the markets, in your accounts, especially if there's a tax advantage account like a 401k or a Roth, etc. We really want to max those out because your rate of return there is probably going to be closer to 10, 11, 12% versus the interest on the loan costing you 4, 5, 6%. So you really shouldn't apply extra towards that principal. Stretch that 30-year mortgage out. Don't do a 15 unless you just are really awful with money and you know that a 15 is going to force you to get it done sooner and you have some job security above and beyond the normal person. I'd say maybe do a 15 in that case. Other than that, the 30-year is going to be your option. And this is what most people choose anyway. So max flexibility. And really, I can't stress that enough in life when it comes to money. It's very fluid. And so it's very nice to have that 30-year fixed essentially too. And then when you think about things like inflation and whatnot too as well, really what is that mortgage worth for inflation 30 years down the road? It's the same interest rate. It's the same. You're paying the same dollar amount as you are today essentially on that fixed 30-year mortgage. When you make your final 30-year payment, you're making that same dollar amount. Let's just say it's $2,000 a month on that mortgage. That $2,000 a month is worth a lot less in 30 years from now because of inflation. So it really does make sense to hold that debt, stretch it out over time, invest elsewhere, build up your liquidity elsewhere, build up your accounts, realize maximum tax savings, etc. I really, I don't think I'd ever encourage someone to do a 15-year, again, unless it's a very, very specific scenario. Hope that helps on your decision. Thanks, guys.